Hello everyone. Today at Commerce classes we will be practicing applications of break-even point analysis and managerial decision making. In CVP analysis we have studied that there are two methods for the analysis. One is profit volume analysis, another is break-even point analysis. And most of the applications in each are same, like we are to calculate sales at a desired profit level, or profit at a desired activity level, or changes in our values or our calculations depending upon change in the variables. That is, if the fixed cost, variable cost, selling price, quantity, if these are changing, then how does it affect break-even point, contribution, PV ratio, sales, etc. So these major applications which are common, these are to be studied today through break-even point analysis. So we are starting with first question. Following is the budget of Chroma company. Alright. So budget is given. Budgeted sales are at the rate of 25 rupees, 2 lakh units. It is 50 lakhs. Now we are given material, labor, factory overheads, office overheads, sales and total cost. So this is given in total and profit is measured. Now when this total is given, it means that per unit information can easily be calculated. Because we know that there are 2 lakh units. So if for 2 lakh units, variable cost is 26 lakhs, it means per unit it is going to be 13. Right? 26 lakh total cost divided by activity, that is 2 lakh units. Same fixed cost per unit can also be determined if the need be. Now, what we have to do in this question, it's a basic simple question, calculation of break-even point in different situations, like when cost is changing, variable cost is changing, and both the costs are increasing or reducing, selling price is changing, then how does it affect our calculations? Alright. So, basically this complete question is relating to break-even point and effect of changes in the variables on the break-even point. So that we are going to study through this. Now, let us start with the basic question. Now, before we make calculations, we usually present our information in form of a statement. That is contribution based cost sheet. Since we are having different components of cost, so do we need to record all? Since in this problem, we are not distinguishing between various components. The only distinction is fixed and variable cost, isn't it? So they are not saying change in factory overhead, so change in material cost or change in labor cost. So when we are making the cost sheet, we don't need to record these separately. We can give a joint combined information as variable cost. If your question was saying, say, material cost is increasing by this, labor cost is reducing by this, which implies that you need to record them separately. So therein we will be mentioning the details. But if in a question there is no change in the individual components of the cost, then we don't need to record the details. So in our case scenario 1, when our activity level is 2 lakh units, our cost sheet based on per unit information. Selling price is 25 rupees less variable cost, which we have calculated as 13 rupees per unit. So we are left with contribution of 12 rupees per unit. So PV ratio will be contribution upon selling price into 100, that is 12 upon 25 into 100, that is 48%. So we have calculated this. Fixed cost is now 18 lakhs. Alright. So we are to determine break-even point. Now our question doesn't specify that is it a point in terms of units or in rupees. So for our own understanding, we are now making calculations for both. So if we are taking up units, in case of units, we take per unit information. So it will be fixed cost upon contribution per unit, that is 18 lakh upon contribution per unit is 12 rupees, right? This is contribution. So that gives you 1,50,000 units. But if you are to calculate break-even sales in terms of rupees, then for rupee information, contribution is replaced with PV ratio in our formula. So it is 18 lakh divided by PV ratio 48%. So that gives you 37,50,000 rupees of break-even sales. So our first scenario gives us break-even point as 1,50,000 units or 13,75,000 rupees of sale. Second is 10% increase in fixed cost. So if our fixed cost increases by 10%, we have to take up independent situations of one after another. Okay, so in the second scenario, what we have is fixed cost is plus 10%. So rest of the things remaining same. So we can continue with this. Selling price 25, variable cost 13, no change in this. Contribution same. So PV ratio is also going to be same, that is 48%. So now fixed cost is 10% increase, so 18 lakh plus it's 10%. If you add 10% of this, your fixed cost is going to be 19 lakh 80,000. Alright. So break even point now will be fixed cost upon contribution per unit, that is 12 rupees. So that gives you 1,65,000 units, and break even sales with this formula will be fixed cost upon PV ratio, which happens to be same. So it is now 41,25,000. So when fixed cost changes, how do you analyze its effect? If fixed cost increases, it won't affect your contribution or PV ratio because they are not having fixed cost as a component there. But it is a component in calculation of break-even points. So fixed cost is numerator. When numerator increases, the value of fraction also increases. So increase in fixed cost will bring in increased break-even point. But this we cannot say improvement. It is not improving your situation. In fact, in case of break-even point, if it is increasing, it is a loss or unfavorable position to the company, because earlier you were able to get profit after making sale of 1,50,000 units. Beyond this, every unit sold is fetching you contribution, pure profit. But now you need to sell 1,65,000 units to break even. So after this only you will be getting profit. So increase in break even point is basically unfavorable to the company. So company's procedure is usually, or they try to reduce break even point, bring it down. So if it is increasing, it is not favorable. Next case is 10% increase in variable cost. So if your variable cost is increasing by 10%, this is next scenario. So variable cost will be affecting your contribution because variable cost is 13. So if you add 10% of this, your variable cost is 14.3. That means your contribution is going to be 10.7 per unit. So your PV ratio will be contribution upon sale into 100, that is 42.8. Now fixed cost is same. There is no change in this scenario because every scenario is independent of the other. So break even point will now be fixed cost upon contribution per unit, or break even sales will be fixed cost upon PV ratio. So your calculation gives you 1,68,224 units or 42,05,600 rupees. So what does it imply? If our variable cost increases, since variable cost is indirectly related with contribution, it is selling price minus variable cost. So when variable cost increases, contribution will reduce, PV ratio will reduce. But as this ratio reduces, your break-even point will increase. On the whole, what we can say is that whenever our cost is increasing, whether it is variable cost or it's for fixed cost, it is likely to move your break-even point up. Because when cost is increasing, it means you need to sell more to cover all the costs. So in order to break even the cost, you need to have higher sales. So break-even point increases. So any increase in the cost, whether it is fixed or variable cost, is likely to increase break-even points, and it is unfavorable for the company. Now next case is fourth scenario. Now there are two changes, increase in the fixed cost and decrease in the variable cost. So when your both costs are increasing and reducing, right? So we cannot definitely say that our break-even point will increase or reduce. That is whether it will deteriorate or improve, because we don't know the individual standing of this. If this increase is cancelled or compensated by decrease in variable cost, then we may remain same. But if increase is more, then break-even point will move up. If the increase is less and this decrease in fixed variable cost is more, reduction in cost is more, and it compensates increase of the other component, then your break-even point will come down. But herein you see, since increase is more 10% and your variable cost and fixed cost, there is not much difference therein, because it is 13 and it is 9. Okay, increase of 10% here will imply 10% of fixed cost will imply 9 rupees change increase, and 5% reduction here will imply 6.65 reduction, right? So in all, what we can say is that your increase in cost is more, so it is going to up your break-even point. Let us see. Selling price is 25. Now variable cost is less 5%. Since your variable cost was 13 rupees, deduct its 5%. So it will be 12.35. Okay. Now this you can show here also in the inner column. So I am just making it here together so that you can appreciate the difference or comparison of the cases. Okay, so it makes us easy to compare the cases. Otherwise you can make cost sheet separately. You can show these calculations in the details. Now your contribution is 12.65, which means your PV ratio is going to be 12.65 upon 25 into 100. That gives you 50.6%. Fixed cost is same because there is no change here. Or yes, fixed cost is increasing by 10%, so it is going to be 19,80,000. So break even point herein will be 19,80,000 upon contribution per unit, that gives you 1,56,520 units. So your break even point, because we are to make comparisons from the original position. So from original position, break even point has increased. And same will be the case of break-even sales also. 19,80,000 upon PV ratio, that is 50.6%. That gives you 39,13,050. So your break-even point has increased. So increase in the cost is going to move up our break-even points. Okay. Now let us take up another scenario. So now we have seen the changes in cost and their effect on break-even point and contributions. Like when your cost reduces, your contribution increases, PV ratio increases. Contribution was 12, now it is 12.65. It is 48, now moved up to 50.6 because your variable cost is reduced. But because this reduction is compensated or it is cancelled by increase in fixed cost, so overall your break-even point has moved up. Now next case is 10% decrease in selling price. Now, if your selling price reduces by 10%, now what does it imply? Selling price was 25. Now, if it is reduced by 10%, it will imply 25 selling price less its 10%, 2.5. That means 22.5 is going to be your selling price. Now, can you think of the effect of this on your contribution? Since contribution is selling price minus variable cost, so contribution is directly related with selling price. Reduction in selling price will imply reduction in contribution. So less variable cost because there is no change in the cost here. So we'll take up original cost. So your contribution is 9.5, right? So your PV ratio is 9.5 upon 22.5 into 100, that is 42.2%. Fixed cost is same because we are taking information from the original case. So break-even point will be 18 lakh upon 9.5, that gives us 1,89,473 units. And break-even sales will be cost upon PV ratio, that gives you 42,63,150. Alright. So what has happened? If your selling price reduces, contribution reduces, PV ratio reduces. So break-even point is going to increase again. Because in break-even point, contribution and PV ratio comes as a denominator. So denominator is negatively related with the value. If denominator increases, value will increase, isn't it? Now take up the last case. Selling price increases with 5% reduction in units sold. So if selling price increases by 10% and quantity reduces. Now when we are making these calculations, we are not bothered with the actual quantity because we are just calculating break-even point, isn't it? So increase in the quantity, we can write here that quantity has now changed to this, but we won't need it in our calculations. Now selling price is going to be 27.5, right? Because earlier it was 25, now increase 10%, so 27.5. Variable cost is same, so you get contribution as 14.5. Alright, so PV ratio is going to be 14.5 upon 27.5 into 100, that is 52.72%. Fixed cost is same, 18 lakhs. So break even point will be 18 lakhs upon 14.5, that is contribution, that gives you 1,24,137 units. So what we find here is that your break even point has reduced. It was earlier 1,50,000, now it is 1,24,000 something. So when your selling price increases, it improves your contribution, it improves your PV ratio, and improvement in contribution and PV ratio leads to reduction in break-even point, which is indirectly an improvement, because now after sale of 1,24,137 units, you will be making profits. Whereas in the present scenario, you had to sell 1,50,000 units to start making profit, because this was your break-even point. So break-even point has reduced and it is favorable to company. Now break-even sales will be same 18 lakh upon now PV ratio. So we are just calculating one thing and we are trying to understand the effect of different changes over the break-even point. So when your costs increases, it will reduce your contribution and PV ratio and it will increase your break-even point, which is not favorable. When your cost reduces, the effect will be opposite. Reduction in cost will improve contribution and PV ratio and it will improve your break-even point and break-even sales, because then the value will reduce. Okay, break-even point, when it reduces, it is good for the company. Then selling price, if selling price increases, our contribution PV ratio will improve and our break-even point will also improve, which in this case will imply reduction, right? And when selling price reduces, contribution PV ratio reduces and our break-even point deteriorates. Deteriorates means increase, because now we'll have to sell more to make profits. Alright. So we have just tried to calculate the amounts in the break-even point analysis. It involved just to see the changes and their effect on break-even point. Now we'll be taking up a particular question relating to applications and the managerial decision makings. Let us see another question. Now a company manufactures a product currently utilizing 80% capacity. That is, at 80% capacity utilization, you are having a turnover of 8 lakh. So your capacity utilization 80%. Your turnover is 8 lakhs. And your selling price is 25 rupees per unit, which implies that production or sale or activity level will be 8 lakh upon 25, that is 32,000 units. Now this is at 80% capacity utilization. So overall capacity will be 32,000 units upon 80%, that is 40,000 units. So this company has a capacity to produce 40,000 units, but presently it is working at 32,000 units. Now let us see other data. Material cost, labor cost, semi-variable cost. Now semi-variable cost implies that it has a component of fixed cost in this. So our semi-variable cost is 1,80,000, that is factory fixed cost plus factory variable overheads is equal to 1,80,000, wherein variable component is 3.75. So we need to find out factory fixed cost. So fixed cost plus variable cost is 3.75 per unit. Since your number of units at present level is 32,000, so your factory fixed cost will be 1,80,000 minus this is coming out to be 120. So your factory cost is 60,000 fixed and 3.75 variable. So we are to calculate all the basic informations. We need to know fixed cost and variable cost separately. So if it has a component of fixed cost, we need to separate it beforehand before we make any other calculation. Now other fixed cost. Other fixed cost is 90,000 at 80% level, that is if you are working up to this level, you are working at 80%. So up to this level your cost is going to be 90,000, else activity beyond this 20,000 cost will be increased. So your fixed cost is going to be 1,10,000 at 80% if you are working at more than 80% level, right? So if your level of activity is above 80%, then you will be having fixed cost of 1,10,000. So you have two slabs, you can see 32,000 units if you are producing, because at 80% we are having 32,000 units. So up to this your cost is going to be 90, but if you decide to produce more than this, your cost is going to increase, and accordingly your calculations of break-even point will also change. All right. Now break-even point we have to calculate. Number one, break-even point and the activity level at this stage. Now if we have to calculate break-even point, we need to know fixed cost and contribution or PV ratio, right? Since the information is in unit terms, so we can make all the calculations in unit terms. That will be better. Now whenever we are to practice any question, we should prepare a cost sheet based on contribution margin. So present activity level 80%. Now for this level, what do we have? We have selling price 25 rupees per unit. It is given to us, less variable cost. Now components of variable cost are direct material 7.5, direct labor 6.25 and factory overheads 3.75. That gives you 17.5. So your contribution is going to be 7.5 and your fixed cost is going to be, you have 60,000 of factory cost that you have calculated, plus you have other fixed cost. So 60 plus 90, that is 1,50,000 up to 80% capacity level, or 60 plus 1,10,000, that is 170 for above 80% capacity utilization. So this is our basic information which is there with us. Now we are to make use of this information for making calculations. Okay, we could have calculated the PV ratio here, but we don't need it. Reason being, we are not asked, number one. Number two, when you read the question at each stage, they are asking number of units. So PV ratio is not useful here. Okay. So let us start with the question. Number one, break-even point. Break-even point is fixed cost upon contribution per unit. So which fixed cost should we take? Because we have two fixed costs. One is 1,50,000, another is 1,70,000. So we'll have to work one by one. So let us first take 1,50,000, because usually break-even point is reached, nearly 50% level. So we'll take up 1,50,000 as fixed cost. Contribution per unit is 7.5. So that gives us 20,000 units. So 20,000 units implies 50% capacity utilization, isn't it? Because your overall capacity was how much? Your overall capacity is 40,000 units. So if you are producing 20,000 units at break-even point, it means you are utilizing 50% capacity. So you can say that our calculation is correct, because 20,000 units fall within this 80% level, isn't it? Suppose it was coming out to be more, say it was 85%, then we could have written as this quantity is falling above 80%. So we'll have to revise the calculation and we'll take a break-even point as fixed cost 1,70,000 upon contribution. See, in case of management accounting, when we are working for managerial decision making, there is no preset format that we have to work like that only. Some standardized statements are there, like we have cost sheet. But beyond that, we'll have to base our decisions. We have to make statements as per our own understanding. Alright. Now, next is number of units to be sold to earn profit of 95,000 and activity level at that point. So we have to calculate units to be sold at profit of 95,000. So this is desired profit. Now we know that sale at desired profit is equal to fixed cost plus profit upon contribution per unit. This is the formula that you have studied, isn't it? Now, what is your fixed cost? We know that our first level is 1,50,000, our profit is 95,000. So basically trial and error. We'll have to see what is the scenario coming here. Okay. So sale is coming out to be 32,667 units. But we know that it is above 32,000 units. It is above 80% capacity utilization. That is 32,000 units. So revising calculations. Right. So fixed cost is going to be 1,70,000 now, and desired profit is same 95,000. So sales at desired profit will be fixed cost plus desired profit upon contribution per unit, that is 35,333 units. Alright. And your capacity utilization at this level is 35,333 upon 40,000 into 100. So it gives you 88.33%. So this we have calculated. Now next point is number of units to be sold to earn profit of 8% of sales. So how many units should be sold so that we make 8% profit? Now in order to make 8% profit, we'll have to make certain assumptions. Like we have cost sheet with us. Okay. Now in our cost sheet, we had calculated per unit information. Now we'll be taking up total also. Let the quantity be X, because units we are to measure, and our profit is 8% of sales. So our selling price is 25. It means our total sales will be 25X. Variable cost is 17.5. So our variable cost is 17.x. Contribution is 7.5. So our contribution is 7.5x. Less fixed cost, again we'll assume first of all 1,50,000. So our profit is going to be 7.5x minus 1,50,000. Right? But the profit at this level is 8% of sales. That is 7.5x minus 1,50,000 should be equal to 8% of sale, which is 25x. So 2x. So 7.5x minus 1,50,000 is equal to 2x. So solving this for the value of x. So value of X is coming out to be, you can make the calculations. So 27,273 units. And you can calculate capacity utilization also. 27,273 upon 40,000 into 100, that gives you 68.18%. Since it is below 80%, so this calculation is correct. Had it been above 32,000 units, that is 80%, then we would have revised the calculation again. Now this quantity to make sales, number of units to make sales, to have desired profit of 8% of the sales, we have made use of cost sheet, but we could have calculated the same amount using some formula also, because we know that sales at target profit is equal to fixed cost plus profit upon contribution per unit. Now let us assume we are selling X units. So fixed cost is 1,50,000, profit is 8% of sale. 8% of sale upon contribution per unit 7.5. So we could have made use of equation also, we can make use of cost sheet also. So both will give us same results. Now last question, last part, selling price per unit if break even point is to be brought down to 40% of activity level. So you want break even point to be 40% of activity, and your 40% of capacity is, overall capacity was 40,000, so 40% of this is 16,000 units. So if you want to have this much amount here, then what will be the selling price? So let selling price is P. So formula for break even point is, it is fixed cost upon contribution per unit. Break even point is known to us, fixed cost is known to us. Alright. Now what is contribution? Contribution will be sale minus variable cost, isn't it? Because selling price is to be calculated, variable cost is known to us. So now you solve it for this value. So 16 into P minus 17.5 is equal to 150. So solving it for P will be 26.875 rupees. It means selling price should be fixed at this price so as to reduce the break-even point. So you can make use of available information and the formula that we have for various calculations for managerial applications of break-even point analysis or CVP analysis. And if at any stage, if we cannot understand or take up a particular formula that we are to apply, then just remember we have this cost sheet. So the purpose of solving this particular part with the cost sheet was to make you understand that we can make use of formula, we can make use of cost sheet. Both are going to give us same results. The only thing is the formula will give you result directly in 2-3 steps, and cost sheet will require you to make calculations, in a serialized manner. We first calculated the profit, then we used the equation, and then we solved it, isn't it? So it is a bit lengthy, but both will do. They will work for you. If you have any doubt, just go with the cost sheet. Now we can take up another question to understand the applications of break-even point analysis and CVP analysis further. Now taking up another question involving managerial applications of break-even point analysis. So we are given sales and profit of the 2 half years of 2019-20. Okay, sales are given in the first half and in the second half. Profit is also mentioned. Fixed cost is same for both the periods. So it is going to be same. Selling price and variable cost also remain same. So certain assumptions are there that our cost and selling price is going to be same. Whereas fixed cost is taken to be total cost, right? Selling price and variable cost per unit is same. So it will move with the activity level. Now calculate number 1 PV ratio for each of the half years and of the full year. Now when we are to calculate profit volume ratio, then the formula that we can see here is we are given profit and sales. So we can take change in profit to to change in sales as the PV ratio, right? So change in profit is 8,000 and change in sales is 20,000 from here, 30 to 38,000 change in profit and change in sales. So that gives you 40% as your PV ratio. Okay, now we have to see whether it is same for half year and of full year. So since selling price and variable cost per unit remained same, it said that it remained same for both the periods. So whether you are in first half or in the second half, since these two components are same, this implies contribution per unit is also same. So PV ratio is going to be same for each of the periods. Whether you talk about first half, second half or full year, PV ratio is going to be 40%. Second part of the question is fixed cost of the year. So we have to calculate fixed cost. Now again you see we'll have to make use of the formulae. So different people may utilize different formulae to get the value. Like somebody may say that fixed cost is excess of total cost over variable cost. So that person will calculate fixed cost like this. Now what is total cost? Now from this question, can we determine total cost? We are given sales and profit. So total cost is sales minus profit, that is 1 lakh minus 30,000, 70,000. Now what is variable cost? Since PV ratio is 40%, so variable cost is going to be 60% of sales. Isn't it? PV ratio and variable cost of sales ratio is complementary. The total is 100%. So variable cost is going to be 60% of sale of say first, because we have worked here for first half year. So this is 60,000. So total cost and variable cost. Total cost 70,000, variable cost 60,000. So fixed cost is going to be 10,000. Someone else may say that fixed cost can be taken as contribution minus profit, isn't it? Because what is profit? Profit is contribution minus fixed cost. So we can take we can redraw this. Profit is contribution minus fixed cost. So we can redraw this equation to find out the value of fixed cost. It is contribution minus profit. Now what is contribution? Contribution is 40% of sales and profit in this first is category is 30,000. So 40,000 minus 30,000, 10,000 rupees. Now this we have measured for first half. We don't need to calculate it for second half. Reason being, we are given fixed cost is same for both the periods. So what we can say is fixed cost for each half year is going to be 10,000. So fixed cost of full year will be 20,000, 10,000 plus 10,000, right? Now next is break even point of each half year and of full year. So we have to calculate break even point. Now the formula of break even point is fixed cost upon PV ratio. Okay, so break even point of each half year. Now whether it is first half or second half, fixed cost is same in each case and PV ratio is also same in each case. So your break even point comes out to be 25,000 for each half year. Now when we are to calculate break even point of full year, now one of you may say that it is 25,000 for first half year, 25,000 for next half year. So total break even point is 50,000. So you may calculate it like this, but somebody else may say that we can make use of formula. Break even point is going to be fixed cost for the full year upon PV ratio. So they may say that it is 20,000 upon 40%, right? So this is the beauty of this chapter. Since we have very limited information, the amounts are very limited: sales, variable cost, contribution, profit, fixed cost, quantity, what else, but you have interlinkages of these amounts. You may be having these amounts per unit, these amounts in total, quantities might be given, values might be given. So these are interlinked and you can make use of this to make calculations, right? You can use calculations in any manner. You can follow any formula. It will lead you to the proper result provided you are using it correctly. Now next is sales to earn profit of 90,000 for next year. It is year. So yearly information. When it is half year, we'll have to see whether we are talking about half year or full year. So we want to know sales at target profit of 90,000 for the next year. Now how do we calculate sales? Under PV analysis, we have understood that sales at a desired profit are equal to fixed cost plus target profit upon PV ratio, isn't it? This is what you have studied. So fixed cost, we know that for the whole year it is 20,000, alright, and your profit is 90,000, so PV ratio of 40%, that will give you 2,75,000 rupees. Alright, but someone else may say that why not make use of break-even point analysis, because we have calculated it. It won't cost us any further time. We have calculated break-even point. We know this information is there with us. So we can calculate sales using that also. Since we are to make profit, so sales to get some profit is equal to break-even point, because you need to break even to start with profits. So you need to move above this level. So sales at this desired profit are equal to break-even point plus profit that you want to get upon PV ratio, isn't it? Sales is break-even point plus margin of safety, which is profit upon PV ratio. So you need to earn this profit using PV ratio. So your break-even point is 25,000 for the year. Now if you want to make a profit of 90,000, then at 40% PV ratio, you need to get 2,50,000, that is 225. And break-even point is, since we are working for the whole year, so break-even point is 50,000 rupees, 50,000 rupees plus 2,25,000. So that again gives you 2,75,000 rupees of sales. So you will be getting same answer provided you use proper formula. You can use formula based on your PV analysis. You can use formula that we have studied in break-even point analysis. So we have different ways to reach at the same solution. Now profit if the sales of next half year are 1,50,000. Now we are moving to half year. Profit if sales of half year are 1,50,000. Now how do we calculate profit? We know that our formula of profit is contribution minus fixed cost. Okay, so contribution is sales into PV ratio minus fixed cost. So your sales are 1,50,000, PV ratio is 40%, fixed cost is 10,000 for half year. Okay, you are talking about half year. So it is going to be 50,000 rupees, isn't it? Now someone of you may say that why to use this formula when we know that break-even point for half year is 25,000 units, right? Break-even point for half year is 25,000 units. That means once you reach 25,000 rupees, you have break even. So beyond this, you are going to get profit. So if you have sales of 1,50,000, then you will get profit only if your sales are above break even point. So on the extra sale, you will be having profit of PV ratio. So now sales minus break even point into PV ratio. You don't need to deduct fixed cost here because break even point takes care of the fixed cost. So your sale is 1,50,000, break even point is 25,000. So 40% of that. So again you will be getting 50,000. So you have variety of formula here and you don't need to look here and there. You can use this formula or that formula, and if you do not understand any formula, you do not come with some formula in a given scenario, then just go with the cost sheet. Okay, so that will be the final answer. Just go with the cost sheet, and wherever you have data, put in that data, and that cost sheet will be translated into the equation, and that will give you the result. Solving that equation, you will get the answer. You can make cost sheet also in this case. Like if we have sales, so you can say that sales are 1,50,000 less variable cost. So variable cost is 60%, right? Less fixed cost, that will give you profit. So it's up to you how you value this. It doesn't matter you go by this formula or that formula or like cost sheet. Now last, sales to earn profit in next year. Okay, yearly information is needed. You want to determine sales. Sales is something that you are to determine. Assuming, so you are to make profit in the next year same as that of this year. So you want to make same profit. So can you tell me target profit? Just pause the video for a while and just think of target profit. It is the profit of the next year same as of this year. So how much profit was there in this year? Just wait for a minute. Yes, profit of this year is 68,000. So this is your target profit. Okay, your fixed cost is going to be same because for calculation of sales, our formula is fixed cost plus profit upon PV ratio. So fixed cost is same 20,000 rupees. However, it says that there is a decline in selling price by 10%. Now your selling price is declining but cost is going to be same. So our sales at desired profit are fixed cost plus target profit upon PV ratio. But can we use same PV ratio that we have determined? 40%. Fixed cost is same, there is no change. Profit we are going to make same as of this year, no change. But PV ratio is going to change because your selling price has declined by 10%. So now we will have to revise calculation of PV ratio. So if you revise the calculation, alright. So revised PV ratio will be, so present scenario is, you can take up any information, say 1 lakh. Okay, variable cost 60%, contribution 40%. Okay, and PV ratio 40%. But revised amounts or next scenario, your sales are going to be less 10%. It means in the next year your sales will be 90,000. Variable cost no change, it is going to be 60. Okay, and then contribution will be 30,000, which implies your PV ratio is going to be 30,000 upon 90,000 into 100. So that is 100 by 3%. Okay, so your PV ratio is 100 by 3%. So your sales at target profit will be fixed cost 20,000, profit 68,000 and 100 by 3%. 88,000 upon 100 into 3 into 100. So 2,64,000 rupees of sales are needed to make the profit as of current year. So whenever any value changes, our ratio will also go for a toss. So you will have to change it. Now we used this formula to determine sales, right? This is a formula that we studied under PV ratio. Now what is the formula under this break-even point analysis? Sales at a target profit. You know that in order to make some profit, we need to break even and then we will have to get the target profit at a given PV ratio. Now we could have used this formula, but the problem herein in this, that if you use this formula, the way you revised PV ratio, you will have to revise break-even point also. So that will involve another investment of time. So in exams we might not be having enough of time to revise all the calculations, so we should make use of the best possible way. So wherever we have the maximum information available, we should make use of that particular formula. So this is how we can solve questions relating to managerial applications of break-even point analysis. So next time we'll be taking up some more questions wherein we'll be studying managerial decision making based on break-even point analysis and some specific applications of BEP. So meanwhile, keep practicing, keep smiling. Thank you.